All right, guys. This is a pretty simple one. Chapter 4, Section 3. We're going to talk about applying for credit and what your credit history does to you and how it hurts you in the same way. So applying for credit, a couple questions we may ask ourselves is how do you apply for credit? And what factors determine whether or not you will be approved for credit? And how do you dig yourself out of debt if your payments are more than you can handle? This is a very important one to think about. We may forget about our Mr. Stoffer teaching you how to use credit cards and revolving accounts and all the different things along those lines. And if we do forget, maybe there's that inkling in your memory bank that says, "Oh my gosh, Mr. Stoffer, I remember doing this, and he taught me how to get out of debt." And then maybe you look some stuff up online or something like that, and you're able to get yourself out of debt. Not easy to do. Once you get yourself in debt, it's a lot harder to get yourself out of debt. Okay, telling you that right now. So first and foremost, what if you don't take Mr. Stoffer's advice and get a credit card and pay it off at the end of the month? Keep a track record of yourself for the credit bureau, and you get yourself into credit card debt, and you make the minimum payments, and you have a large debt to income ratio. You might be late on a couple payments. Well, you're probably not going to be able to buy a house. You have large student loan debt. Okay, these things that can keep you down for a long period of time. You might not be able to buy a house until you're 40 unless you take the right steps in college or in tech school or limit that spending on your student loan debt and keep a low debt to income ratio when you actually do get a job. Then you might be able to get a house. A quarter of the national budget is contributed to student loan debt. It's like 10 or 11 trillion dollars is federal student loan debt, and it's a problem. It's a problem in this country. A lot of kids can't get rid of it, and keeps them from getting credit to buy homes and keeps the market stimulated. So the first thing you need to do when you want to get credit is you fill out a credit application, whether you're applying to get a mortgage or a car loan. Um, there's a couple different credit bureaus. Experian's one. I can't really remember the other ones. Equifax, and there's another one I'm forgetting, but there's three major ones. There's four of them, I think. But these are all federal credit bureaus, and they all track your credit scores, and they're in general right around the same number. They can range anywhere from 300 to 900. The higher your credit score is, the better likely you will get a better interest rate, which then in turn will lower your monthly payment. So the investigation will reveal a couple things when they run your credit. It will reveal how much income you make, the Social Security income from the federal government, any current debt details about your personal life. So if you have any credit cards on tap that are running at the minimum wage balance, you have any loans that you've taken out, your student loan debt will be on there. Everything that you have will be on there about your personal life. They know everything about you. And how well you have repaid debts in the past. If you have any late payments, that will signal cues, um, delinquencies in your account, and it can hurt your credit score and drive your credit score down. This will then reveal your credit rating, and it will spit you out whether you are good, average, poor, great, terrible. Okay, and credit ratings are the risk these have. And say you want to buy a car, you really want to buy a car, and you have a poor credit score. Well, the bank simply won't loan you the money, or you want to get a mortgage to buy a house for your family. The bank simply won't loan you the money until you bring your credit score up, which could take you anywhere from 2 to 3 months to bring that up. Okay? Credit history. Past history is important in banks deciding credit worthiness. Creditors look at three main issues involving credit and giving credit capacity. Number one, capacity to pay. How much debt you have in relation to your income. This is number one. Okay. Your character, trustworthy. You a trustworthy person. This goes into late payments, so on and so forth. Believe it or not, there's some really weird things in there. I've looked at my credit report more than one time, and you can actually see like, hey, if you misprint your name on an application, or you change addresses a lot, this will ding your credit score. Make sure that you are solid when you do these things, when it comes to right down to it. Also, if you get in trouble with the police, things go on your criminal record. This can drive your credit score down. Yeah, you do something stupid now, and you're 18, 19 years old, 17 years old, it goes on your record, and this can affect you buying a house later on in the future for your family. So be very careful about what you're doing. Okay, your trustworthiness and your trustworthiness as a person. You commit truancy in school, you don't show up to school, that goes on your record. You go see the judge. These are all things that can drive your credit score down. And any collateral you may have, your overall personal wealth can affect it in a positive or negative way as well. So what hurts your credit rating? Late payments, high debt to income ratio, having many open accounts. Okay, you have too many 6, 7 credit card open accounts, and they're all running at the maximum budget or close to, or you're only making the minimum payments. This is going to drive your credit score down, guys. Okay, make sure you're paying your credit cards off. You don't have any credit cards. Like I said, you have one credit card open, pay it off at the end of the month. It keeps that track record of you. You have previous bankruptcy, it's over for you. You can't get any kind of credit for up to 10 years. So bankruptcy is basically you file with the federal government. They suck all your debt in. You can't get any bank loans for 10 years. Thank you, guys. I appreciate it. Wow, that's so nice of you guys.
Thanks, Paul.
Yep. And then unemployment. If you're on unemployment, this can affect your credit rating as well. And any legal trouble, like I was saying before, this definitely affects your credit rating too. This will all be spit out what we call the Fair Isaac Credit Corporation, and this is where kind of they will run your credit score, and all these attributes will either hurt or help your FICO score. This is a type of credit score that makes up a substantial portion of the credit report that lenders use to assess an applicant's credit risk and whether to extend a loan to you or not. So FICO is an acronym, like I said, for Fair Isaac Corporation, the creators of the FICO score. So you can get on apps now to track your credit score and can kind of tell you how to improve your credit score. So when you are ready to get that house loan or that car loan, you're ready for it. You have a good score. It's going to give you a low fixed interest rate, and you're able to make a move financially responsibly. It's not a bad idea to go into, I personally have a smart credit app just in case I have to buy a home or buy a car or do anything that I want to do, because I just, in a real world, the Dave Ramsey way, and I love Dave Ramsey and the way he does it, but he says buy everything in cash. That's difficult to do in today's day and age. And I understand that if I could, I would buy my house in straight cash, but I just can't. Okay, I can put a substantial large down payment from doing it the correct way, but I'm not going to have that money on hand, especially if I'm a teacher now, if I'm a doctor or something like that, and I'm doing it the correct way, budgeting, saving a large financial sum per month. Yeah, then maybe I would be able to, but I can't. Therefore, I got to make sure that my credit score is in good standing, that I can be able to get a low fixed interest rate. So when it comes to my disposable income or my discretionary income, I'm going to have enough available funds at the end. So all my necessities are paid in my disposable income or through my discretionary income. And I'm able to move forward with my life and be able to do these things in a good manner. As you can see here, here's how the FICO score looks up. Your length of credit history is 15%. So have you been paying the minimum balance for 5-6 years? That's going to ding your credit score. If you haven't been paying the minimum balance, you've been paying them off in full, and they see that, and you have a long line of that, and you use them and you pay them off, and you use them and you pay them off, because you use one and you pay it off, all right, then it's going to affect you positively. Any new credit, 10%. Okay, when you open up an account, it sometimes can affect you in a good way and sometimes in a bad way, depending on how you use it. The amounts you owe, that's the debt. Your payment history is 35%, and then the credit mix is 10%. So you have to be very careful on how you're using these. There's two different types of loans that are going to be on your test. Number one is a secured loan. When you go to buy a house mortgage, they will, in general, want you to put 20% down of a house. So if you buy a $300,000 home, 20% of $300,000 figures out to be, let's just do it real quick, 20% equals $60,000. They would like you to put $60,000 down. If you can put $60,000 down, that's good enough for them to lend you the money with a good credit score, with a good fixed interest rate, and gives you a little collateral. It gives the bank a little collateral. They're a little more willing to do that with that 20%. And you won't have to pay what we call mortgage insurance. Once you own 20% of your house, an extra $100 some odd comes off of your monthly budget. And it's a good number to put down. It will give you a secure, good fixed rate for your house, which will give you a lower monthly payment. The collateral may be the item being purchased or something of value. So if you have a 403B, you could use that if you put a lot of money into that, meaning savings, to use as a secured loan. The borrower then signs a legal agreement of not allowing the lender to claim the collateral if a loan is not repaid. For instance, you could use your house if you want to run a line of credit against your house or have a refinancing your house. You use your home as the collateral, meaning if you can't pay your mortgage, they will come in and foreclose your home, and the bank will repossess your home and resell it to make that collateral. This is what happens in general when you buy a home. Okay, so it's pretty common for them to use your home as collateral. An unsecured loan is when a financial institution lends out funds based on a person's reputation and promise to repay it. A bank will also sometimes make some of you have a cosigner. Oftentimes on student loans, when you don't have a job at this point in your life, your mom or dad will have to cosign for you. A cosigner will promise to pay off the loan if the borrower does not. Okay, so these are very important when you do these things for secured and unsecured loans. Unsecured loan is you have no collateral. A secured loan is you have money. You have money to back up your investment that you're trying to invest in. So those are the two different things. Remember, what are the three things? What I want you to do now for your assignment today is I want you to make a poster. I want you to split the paper in half. I'll post an example of it. On one side, I want you to draw a picture of what good credit looks like. And on one side, I want you to draw a picture of what bad credit looks like. I want you to then, let me see here. Oh, good and bad credit. Okay, so I want you to do the good and bad credit poster. And yeah, that's that. So if you have any questions for me, please shoot me an email. I'm going to post an example of the good and bad credit poster. You guys can do something similar to that. 3 good reasons to get good credit and 3 bad reasons. This is going to be on your exam. This is one of the reasons why I'm doing this. Okay, guys, have a good day.